Gold and silver are hitting historically high levels, breaking records and defying traditional market behavior. But what's really pushing these precious metals higher? And should retail investors care? Precious metals are in rare territory. Gold has climbed above $5,000 per ounce, driven by a wave of buying from central banks, retail investors, and safe haven demand. Silver recently crossed $100 per ounce, an astounding rally compared with the past decade. Copper and other industrial metals have also surged, signaling broad commodity strength. Several structural factors are in play. Weakening U.S. dollar. Precious metals are priced in dollars, so a weaker dollar makes them more attractive. Central bank purchases. Global central banks are buying gold at record rates as part of reserve diversification, reducing U.S. Treasury exposure. Retail demand and ETFs. Investors buy physical bars or exposure through ETFs. They don't have to hold bullion directly. Economic and political uncertainty, concerns about debt levels, geopolitical risk, and monetary policy push investors toward tangible assets. These drivers can keep underlying demand elevated even if short-term traders call prices frothy. Silver isn't just a monetary metal, it's also a critical industrial input. Silver is used in semiconductors, electronics, solar panels, electric vehicles, and data centers. As AI expands, demand for high-performance chips, power management systems, and energy-intensive data centers grows, all of which rely on silver's conductivity. Over the decades, gold has moved from under $40 per ounce in the early 1970s to levels above $5,000 per ounce today in some markets, a massive long-term trend. Silver's long-term average was under $20 per ounce, making today's levels remarkable compared with historical norms. These moves aren't just cyclical, they reflect decades of monetary shifts and reserve diversification. Precious metals can play a role in portfolios, usually as part of a diversified strategy. Many financial advisors suggest something like 5 to 10% of a portfolio in gold and/or silver. Enough to provide a hedge, but not so much that volatility dominates returns. Gold and silver don't pay dividends or interest, so their opportunity cost can be high when yields rise. They can be volatile, silver especially, because it's both an investment and an industrial metal. Recent rallies have brought some warnings of short-term overheating, and commodities aren't immune to broader market shifts. Changes in interest rates, dollar strength, or supply dynamics can trigger corrections. Gold and silver prices are being driven by a mix of weak dollar dynamics, central bank demand, retail flows, and macro uncertainty. They can be effective hedges, but they come with volatility and no yield. For long-term investors, modest allocations make sense, and ETFs offer easy exposure without holding physical bars. Please like, comment, and subscribe.